Warner Brothers Discovery is up 23% year to date. This is a very, very hot stock that people are looking up on YouTube. So here we are to do an analysis of it. Stay with us in this video. There's something in this video for beginners all the way to more advanced investors, and stay the entire time because as we go along in the video, there'll be better and better things in the videos discussing Warner Brothers Digital. So we're going to go Discovery. We're going to go through some bull and bear cases from our community. Our community chat here, we have people in there. They're giving their bull and bear cases. We'll give them a shout out. We're going to go through the 8 pillars, some high level metrics, analyst estimates, and then we're going to obviously finish it off with the stock analyzer tool, which will tell us, based on our assumptions about the future, what price to pay for this stock. So guys, stick with me. If things sound confusing, it's okay. It was confusing to me when I started, but I guarantee if you just watch a few videos on this, you'll get a better and better understanding. And no matter where you are on that spectrum of beginner to advanced investor, there'll be something new for you in this video. So let's go check it out. So Warner Brothers Discovery is the result of combining two large media firms. It's one of the biggest media firms in the world with tremendous scale and reach. The new company owns some of the biggest global networks, including HBO, Discovery, CNN, and TLC, as well as Superman, Rick and Morty, and Game of Thrones. So guys, it is incredible with the content they have, right? It is a $28 billion market cap business. This means if you bought all the stock that's out there in the market, you have to spend $28.85 billion. Now, one of the biggest concerns I have with them, their enterprise value is $108 billion. So this $80 billion difference is essentially debt. Okay? That difference is debt. So the first thing I'm going to say is, yeah, I just heard a wow in the background over here. That's a lot. And here's why also. Their free cash flow last year was only $3 billion. That concerns me immediately. Remember, debt works for a company the same way it works for you. Okay? As a consumer, as a person at home. Let me give you an example. Let's say you live in your house and your neighbor has a very similar house. But you have no debt and they have $10 million of debt. Not just on the house, but on everything. Who is more likely to have financial trouble if things start to go poorly? It's a very clear answer. The neighbor with $10 million in debt. Now keep in mind, I'm not anti-debt. I don't go to that extreme saying debt's bad. No, debt can be good and debt is useful. But just like most things in life, the more extreme we get, the worse it is. And unfortunately, with companies, the more extreme your debt is, especially recently, in the last 5-10 years, with interest rates so low, companies could get away with a lot of debt. But now where interest rates are higher, and even though their rates might not be maturing yet, when they eventually have to refinance, they're going to have to spend a lot of money on that debt to increase the interest costs for them. And that can really drive down somebody's free cash flow. That is my first alarming thing about Warner Brothers Discovery. All right. Now, negative profit margin, negative 5-year, gross profit. It's just, let's go to the income statement because I want to see what's going on here. They split it off and they split off the revenue and profit. Oh boy, just a lot of bad news out there. Like I'm looking at this going $3 billion charge this year. Still doesn't account for the $6.7 billion they lost. In the last 5 years, they've averaged a loss of $1 billion. So, again, let's go to the 8 pillars here. Oh boy. Oh boy. Now, the 5-year price to free cash flow is 10.47. But remember, that's just the market cap. Now, the good news is their 5-year free cash flow average is 2.76 billion, but their 5-year average net income is a negative 1 billion. So their free cash flow is higher than their net income. And this 10.5 to 1 5-year price of free cash flow says that if they repeat the last 5 years of free cash flow the rest of the time, you would essentially get your money back in 10.5 years, which sounds awesome. And I'm not denying that that's not great. It is awesome. But at the end of the day, you still have to worry about that debt level. What's going to happen? Let's go to their balance sheet and check that out. So we go to their balance sheet and look at their long-term liabilities. So guys, the $65 billion in long-term liabilities that this company has. All right. If the average interest rate, let's call it hypothetically, is 4% because they started taking their debt on years ago. Actually, we can figure out exactly what it is. Let's find out exactly what their total liabilities are. $81 billion. And we can go sit here. Their total and we go to their income statement and see their interest charges. $2.26 billion. Okay, so they spent $2.26 billion, and let's call it on their long-term liabilities total, which are $65 billion. So 2.26 divided by 65. Their average interest rate of 3.47. Now, guys, this is back of the napkin. I'm not saying this is 100% correct because there's also in their balance sheet current portion of their long-term debt. What that means is what part of their long-term debt needs to be refinanced next year. Now, at 3.47%, that sounds really good. Well, yeah, because they got the debt when interest rates were low. But now interest rates have gone from 0% to 5.5%. What does that mean? Let's say their interest rate goes from 3.5 to 6.5. That's 3% more on $65 billion. What's 3% of $65 billion? So $65 billion times 0.03. They're going to increase their costs by $2 billion per year. Well, guys, remember, their net income, their free cash flow is $2.76 billion. That's going to eat up 80% of their free cash flow, 70% of their free cash flow. That's a concern I have for the company. Now, does that mean they can't grow their revenue and make up for that? Of course they can. Of course they can. But at 38% gross margin, hear me out here. This is going to be a little technical. This means for every extra dollar they sell, 38% of it goes to be able to pay overhead and interest charges. Now, if they have $2 billion in extra interest charges divided by 0.38, that's their gross margin, they got to get an extra $5.3 billion extra in revenue just to cover that extra interest charge and be worth the exact same amount of money, assuming no other increases in any other costs. Okay, it doesn't seem unreasonable because they have their income statement is $41.9 billion in revenue. Okay. They have to grow by 12 or 13%. All right, not bad. Let's go see what analysts are saying about that. Analysts believe they'll hit that in the next 4 years. So you're going to have 4 years essentially, potentially of no growth. Now, that doesn't mean, I'm not sitting here saying that this means it's going to happen and you should avoid it. It's just something to consider when you're thinking about investing. When you're thinking about investing in a company with that much debt, you really got to understand what's going to happen if the debt goes up. Now, if we were in the 1980s and interest rates were going down and there was a lot of debt, I would say, hey, look, the good news is we're probably in a downward interest rate environment. So you're probably going to save more and more money as things get better, as interest rates go lower. But we're now just getting back to more normal interest rate times. Is it possible that interest rates go further down if we hit a? Sure, it is. But when we were at 0%, that was a lot different than when we were at 5.5%. So you've got to decide for yourself what's important for you to understand there. All right. And guys, remember, in our 8 pillars, if you're part of our community, you can customize these 8 pillars up to 12 of them. So I want you to remember that. Okay. So for analyst estimates, go back to it. They're expecting WBD to lose about $1 a share this year, but going to $1.54 by 2027. Well, the stock price is currently at $11.72. Wow. So let's say they do hit that $1.50 in 2027. They're selling for about 7.5 times 2027's profit. That's not bad. Not bad at all. But again, the question is, what's going on with the company going forward? Is that reasonable? I don't know. Now, I guess it leads to the question we have most. What's the right price to pay for Warner Brothers Discovery? Now, some interesting things here before we get in the stock analyzer tool. Michael Burry has a big position in this. So we're going to pull up Michael Burry's 13F and see what he's actually got right now, how many shares of it he has. So let's go find out top buys. So here's all of his holdings right here. WBD, 375,000 shares, market value of $4.7 million. So not a big part of it. But it's a little misleading because of these S&P and QQ and NASDAQ puts he has, which isn't really a $1.6 billion investment like people made it out to be. He's buying puts on them, his investments, whatever he paid for each option here. So let's say he paid $2 for each one. He's at $8 million investment. Okay. Now, $4.7 million worth, I don't know. Maybe it's a lot. Again, Michael Burry is a very, very smart man. I do not deny that at all. He's wonderful. He's smart. I look at him all the time. But again, I'm here to make my own decisions that make sense to me. I like seeing him own it because I look at it going, okay, it's something I need to look into. But if it doesn't make sense to me, I'm just going to avoid it. Because at the end of the day, I can't go blame him. I got to find a process that makes sense to me. And that's what's really important. In our community today, I actually wrote a quote from Li Lu, the famous investor out of China, where he talks about how important it is for you. Actually, let me pull up the quote right here so people can see it in our community. I'm just going to pull up every week I do 2 or 3 quotes in here. And the quote is this, and it's very important. Part of the game of investing is to come into your own. You must find some way that perfectly fits your personality. So if these investments don't fit your personality, don't do them. Even if the investor you love the most in the world owns it, it's got to make sense to you, because at the end of the day, if the stock price falls, you're not going to know what Burry's done until 3 months later. What if he sold it? What if he's bought? I don't know what he's done. So that's why it's about understanding that process. And that's why we do that here. And guys, great news is for Stock Analyzer, before I get into Stock Analyzer tool, I have some really exciting news. The last few weeks, I got an email from one of our most active members in our community, and he wrote a wonderful email. He talked about how it really changed his mindset and way of investing. And he even said, I don't agree with you on everything, Paul, but he gave me a suggestion that I'm going to take his advice on. He said to me, Paul, when I was looking at your software before, I was like, I don't want to spend $30, $40 a month. Then finally you offered $7 for 7 days, so I took you up on it. Best decision I made. But he made a recommendation. He said, but you're missing out on great investors, active investors like me, by not giving people a free sample. So this is what we're doing now, starting today. We're doing full, free 7-day trial, full access, everything on the software. Nothing will be held back. Full community, full everything. Sign up at the link below. You get 7 days of full free access, nothing required besides your email to sign up. That's it. So go sign up now. You get full access to everything here. This is a no-brainer, guys. I made an offer that I thought to myself, you'd be crazy not to take. So this is it, guys. If you've thought about signing up, go do it now. So let's use a Stock Analyzer tool now to determine what price to pay for the company. Now, this is based on our assumptions about the future, and I want to make note, especially for a company like WBD. This does not include the balance sheet. Now, before we get in the Stock Analyzer tool, again, let me go to the community. We have a chat in here for WBD where we ask for the bull and bear cases for Warner Brothers Digital. Warner Brothers Discovery. Why do I keep saying digital? So I'm going to make it a little bit smaller so I can read it easier. Oh boy, there's a lot. All right. So Rich writes, bull case, Discovery has the largest TV and motion picture library in the world. Wow. Bear case, even though aggressively paying off their debt, extremely high with interest rates rising. Agree with you 1,000,000%, Rich. 1,000,000%. I agree with you 100%. Okay. Chris, bear case, they're losing money on streaming and might never become profitable. Okay, maybe so. All right, Wicked Willie. Now, Wicked Willie is Dalton. He's our analyst. He starts October 1st working for us. He is awesome. He asked the question about the debt. He's just engaging people here. So back to Dalton. Dalton says 2 bull cases, shifting to max service that's ad-free and $15 per month. That's HBO Max. That's 1. 2, raise guidance to $5 billion of free cash flow for the full year based on the success of the Burry franchise. That's temporary, though, as well as maintaining its commitment of net leverage ratio of 2.5 to 3 by 2024. So they're very big on paying down this debt. I like hearing that. I love hearing that. Even though it's a low interest rate debt right now, pay it down, put the company in a good position that they're not going to be susceptible to higher interest rate charges. Year over year, total subs and revenue per user internationally and domestically were up. Guys, it's all about the game. How do you generate money per user? That's the game in here. All right, 2 of his bear cases. Strikes from the writers are expected to cost WBD $500 million and drastically affect the company's ability to create new content. Guys, there's a writer's strike going on right now. It's been going on since May or June or something like that. So but again, just like I said, Barbie was temporary. This is temporary. It's a temporary issue. It's not going to be, we're not going to have a strike forever and not going to have Barbie forever. Another one, studio revenues fell to $2.6 billion in Q2 2023 from $3.4 billion a year ago, or a drop of 23%. All right, Chris, Netflix. Okay. Oh, here's a good one. So I'm hoping I pronounced this correctly. Ciatras K, bull cases. They have a lot of content. The merger expects to generate $3 billion plus a year that can reinvest or reduce their debt. their streaming business went profitable this year in the US. Okay. It's a little bit different than what Dalton said, but maybe they weren't profitable in the past and now they are profitable. Bear case. Oh, yeah. The $43 billion in debt, lots of competitors and lots of subscribers when they merge the platforms. Okay. Black Panda writes, currently their debt is man, everything's about the debt, guys. Yeah, look at D Money. D Money is writing, I personally avoid companies with high debt. So Michael Burry doesn't mind it. D Money does. And I love the fact that D Money, when I hear this, what I say is, I love hearing this because he's like, listen, I'm okay. I don't have FOMO. If I miss out on this one, I'm fine with that because it doesn't fit my criteria. That's what I love accentuating in this community. That's what I love. Let's see here. Vikes 1, bear case, too many players in the streaming service. I gotcha. Discovery Channel has ruined Shark Week. Shark Week, okay. Let's see here. What else? Dan H4, okay, got it. Still, guys, a lot of great. The biggest theme I see here is the debt level. Now, maybe that should be your indication that, hey, the stock has been beaten up so much because of that debt level. So maybe it is. Maybe that's why Michael Burry loves it. He's like, listen, everybody's worried about the debt. The stock has plummeted because of it. All right, so let's make our assumptions about the company. Let's put in our stock analyzer tool. And remember, guys, this does not include the balance sheet. Only the future revenue, profit, free cash flow, and the multiples. So, revenue growth. We were looking at revenue growth from analysts in the next 5 years of, I don't think there's going to be much revenue growth. So I put it at, I'm going to sit there and say 1.5, 3, and 4.5%. I mean, how much is it going to grow from 42 billion? It's making services. I don't know. And it might be very low, but I'm okay with that here. Profit margin. Now keep in mind, guys, there's no profit margin here in the last 10 years. Overall, they've lost money, but their free cash flow has been very positive. So I'm going to focus on the free cash flow. And over long periods of time, free cash flow and profit should be pretty equal. I'm going to focus on this free cash flow and make it for both numbers. So I'm going to go with 7, 12, and 17, which is their 12, the middle number I do here. Remember, I'm doing low, middle, and high. My middle number is below their 10-year number on free cash flow. So I feel like I'm being conservative here. Now, PE. What's the PE and the price of free cash flow that you think the company will sell for in 10 years? We don't know what that is. We have no clue what that is. But what we can do is we can say, okay, the market average is about 15. We go up if there's high ROIC, high revenue growth, big moat, and go down if there's some alarming things we don't like. One of which would be the debt levels. So for this one, they don't have a high ROIC. They don't have a lot of growth. And the debt levels are high. So I'm going to call it 8, 12, and 16. Because let's say they're able to pay down a lot of their debt in the next 10 years. Let's say they take all their cash flow in the next 10 years and pay down their debt. I'm okay with 16. Great content, big company, awesome. I'm okay with that. I'm absolutely fine with that. Now, finally, my desired return. This is essentially my margin of safety. What return do I want to own this company? And again, there's risks involved here because of the debt level. So I might want to put a little bit bigger return requirement because if I buy the market, I can get 9 or 10%. So what do I want to own this company? I'm going to go ahead and say 12, 14, and 16%. Now, I'm hitting the analyze button. And again, guys, free access full 7 days for the software. Go sign up the link below or go to everythingmoney.com/sign up and you will be able to sign up for the software for free for 7 days full access. Just need you guys for one more minute. Hit the analyze button. Yeah, look at this. A low price of 1040, high price of 33, middle price of 20. Guys, this is extremely interesting because the stock's at 1172. If you pay today's price and the lowest assumptions occur, you can make about 10%. Highest assumptions occur 37. Middle assumptions occur 25%. That is the power of this software. Guys, thanks very much, and I'll see you in the community. Take care.